Before we get into this a little bit, I just want to kind of set the stage with a couple of things. So first of all, we're going to talk about using life insurance as part of retirement planning, but I want to be clear on a couple of things. Number one, I'm not saying that life insurance is an investment. It's not. It's life insurance. It's death benefit first. It has cash value that has certain advantages that we can use in some of our planning, but I'm not saying life insurance is an investment. And I'm not in any way saying or say to clients, don't use 401ks and IRAs and things like that. Those are fantastic tools that if people can take advantage of them, they should. And so I'm not looking at this as one strategy is best over all others. As you'll see as I go through this, we're talking about kind of a combination of different things to kind of figure out what the best outcome is. And I won't be talking about this in my presentation, but Ernst & Young has done two different studies now. One came out last year, one came out 4 or 5 years ago that looked at retirement outcomes. So doing Monte Carlo simulations with all sorts of different investment mixes and allocations, and they found that the best results from a retirement income spending perspective and from a legacy perspective were people that had portfolios that included investments, that included annuities, and that included life insurance. Both times that they've done this. So this is an outside third-party firm that twice has confirmed what those of us who've been in the business for a long time have sort of thought that would be the case. But so I look at this as let's use every tool that we possibly can to get the best outcome for our clients. So that's the disclaimer. I'm not an attorney. I'm not a CPA. We'll be talking about some tax stuff, but it's not tax advice. And I'm going to be speaking in fairly general terms. So that's the disclaimer. Our compliance department is happy. And we will go on to our agenda. So we'll talk about some of the conventional wisdom that's out there. This is not going to take the full hour unless we have lots of questions. So please feel free to jump in with questions really at any time. Don't feel like you have to wait till the end. The conventional wisdom, what people have been told for a long time. What's the problem with that, or what are some potential problems with that? And then we'll talk about some alternatives, some different ideas that you might want to talk to your clients about. So what's the conventional wisdom for saving for retirement? Right? People have been told max out your pre-tax accounts, your 401ks, your IRAs, put as much money into those as you can. Excuse me, and defer, right? Defer those taxes for as long as you possibly can. Wait till your RMD age, which keeps going up. It's 73 now, but it's going up to 75. So wait till the last possible minute when you're forced to take money out of your retirement plan. You should think about preserving assets for future generations, right? That's your legacy. So that's where people start thinking about, well, what's a nice safe withdrawal rate of money I can take out, but still leave something for future generations. Oh, but on the other hand, make sure that you have enough exposure to equities. Take that risk because everyone's living a lot longer and there's inflation. So your money's going to have to last a lot longer than it might have before. So you really need to stay fairly aggressive in your investment mix. So that's, again, some of the conventional wisdom that people have followed for a long time. So what's the problem with that? Well, I know this may not be as a large slide, but this is a history of the highest marginal tax brackets in our history. And you see they've been as high as around 90%. I graduated from college in 1983. So the 81 Tax Act had just really finally been implemented, which dropped that top marginal rate down to a relatively low 70%. And you can see the rates have gone down substantially. So now we're with the One Big Beautiful Bill Act that passed last summer. Now we're at 37% is the highest marginal tax bracket that you have. Going forward, who knows, right? The Big Beautiful Bill Act has been labeled permanent, but permanent in Washington, D.C. really doesn't mean the same as how we think of the word permanent. So in Washington, permanent means until the next presidential and the next congressional election cycle, because rates are going to change if there's a different party in power, certainly. And when you think about it, we are really at historically low income tax rates. And we'll go through some of the brackets in a little bit. But with our government spending and the whatever 30 some trillion-dollar national debt, it's hard to keep up with that because it goes up all the time. Um, there's only one way for tax rates to go. And so I think there is some likelihood that we will not see these low tax rates forever. So it really makes income tax planning maybe more important for a lot of your clients than estate tax planning, since we have for a couple up to 30 million that can be left through an estate or gifted during lifetime without any gift or estate taxes. A lot of folks aren't going to have an estate tax problem. Of course, the law could very well change, so who knows? But income tax planning in retirement has gotten a lot more focus lately. Let's talk about, again, one of those conventional wisdoms that says wait until you have to pull any money out of your qualified plan. So here's someone who followed the advice, was very, very successful, and accumulated $3 million in an IRA. And we're assuming they're going to get a 5% rate of return. Those are the required minimum distributions that they have during their lifetime. And you can see it starts out at a pretty good number, but as they age, that number starts going up pretty dramatically. And there's no choice. That money's got to come out, and it's an IRA, so it's 100% income taxable to them. So that can cause their cash flow to take a hit because they got to keep paying more and more to the federal government, and depending on the state that they live in, to the state government. A term that's kind of come into play recently, again with that One Big Beautiful Bill Act, is tax bracket management. I mentioned some of these rates are pretty historically low. If you think about it, you look at that, a couple can make over $210,000 a year and still be their marginal tax bracket's only 22%. Historically, again, that's really, really low. So one of the things that we're talking to clients about a lot is let's take advantage of these tax brackets that we have. And so a couple earning a couple $100,000 a year, their effective tax rate is probably around 15% on a federal level overall. They're in that 22% marginal, but their effective rate is still pretty low. So it's okay to have some taxable income as long as we sort of stay within those limits. And these numbers get indexed with inflation every year, so they go up a little bit. But even at 400,000 of income for a couple, your marginal tax bracket's 24%. So again, fairly low rates, but they allow us to do some planning with how we look at distributions and when we want to pay taxes. But it's not just regular federal income taxes, right? Those of you who are in your 60s or you work with clients who are in their 60s, I'm turning 65 in 6 months. I think I could go out to dinner every week for the next 6 months and attend a Medicare or Social Security seminar in the little city that I live in. Because once you get on that mailing list, everybody gets you. But there's this thing you may have heard of, IRMA, stands for Income Related Monthly Adjustment Amount. And that's for your Medicare Part B premium. The standard premium right now is $207 a month. If your income for a single, you see the numbers there, or joint, that premium will go up from it could be as much as $690 per person per month for Medicare Part B if your income's too high, right? And what drives up incomes oftentimes? We waited till we were 73 to start pulling money out of our IRA. We've got this $150,000 RMD, we've got Social Security, we've got maybe a small pension, or we have some other income, and now suddenly, our income throws us into IRMA and we're paying a whole lot more. The other thing people don't take advantage of enough is a lot of people can incur capital gains on their investments and not pay any tax on it because of their income. So you see the numbers there. So having everything in qualified plans, you don't take advantage of that because it's qualified money. It's ordinary income tax. It's not a capital gain asset that you're using. So you're not taking advantage of those really low rates. If you've got to pay a tax right now, capital gain is the one that you want to try to pay. And then again, with high income, there are surcharges. You may lose some itemized deductions. depending what state you're in, you can, cause some pretty high state income taxes. So again, it's just these RMDs are fixed and there's nothing you can do about them. So it's hard to do regular income tax planning when you don't have that flexibility with income. Here we go. So let's shift gears a little bit. So we've talked about the tax consequences of it. So let's talk about something called sequence of return risk. I mentioned earlier that one of the conventional wisdoms was, well, since people live very long and inflation is still fairly strong, you need to take some market risk because we need the money to last for a long time. So this is just the S&P returns from 2000 to 2019. And if you were unfortunate enough to retire in 1999, the first 3 years of your retirement, they wiped out a whole chunk of your assets if you were invested heavily into equities and into stocks, right? Those first 3 years killed you. The negative 37, that's the 2008, 2009 crash. So if you retired just before then. So the point that we're making here is early in your retirement, if there are negative years, that has a huge impact. If you reverse this chart, and I've seen them, I didn't put it in with this presentation, but if those 3 negative years were at the very end, it makes very little difference at that point, simply because you're that much older, and if the market hasn't gone down, even with withdrawals, you're able to still keep that portfolio at a level where it was. So it's that sequence. And if anyone on the call here can tell me after I retire, what's the best year to avoid sequence of returns, please get in touch with me. If you have that much advanced market knowledge, I want you to handle all my money because obviously you know something that everybody else doesn't know. But that's a huge risk, sequence of returns. And we'll talk about some ways to mitigate that. So just going along with that, if you started in 2000, just taking 50,000 a year out of $1 million portfolio, I mean, not an outrageous withdrawal rate, you've lost 75% of it by 2019. If you started in the year 2000. And so I think someone who's lost 75% of their nest egg in 20 years is probably not feeling very comfortable at that point, especially if they retired early. They could be fairly young and be looking at running out of their nest egg. So not a situation we want to have folks be in. And then finally, we'll talk a little bit about in the problems is legacy planning, right? So the stretch IRA concept is gone, right? Most future generations, so I'm talking about children and grandchildren, have to take all qualified plan money that they get out within 10 years. Some circumstances, they have to take some out every year. Others, they can wait until the end and take it all out. But so it's almost like the problems that the older generation had or could have had, they're now passing those down to the next generation because people who inherit IRAs may be in their 40s or 50s, maybe early 60s, and that could be some of their highest earning years. Right. And now suddenly, if they're in fairly strong tax brackets, now we're going to add money that they've got to take out over a 10-year period. And so that's going to throw them into higher brackets. It's going to cause them to lose deductions and pay surcharges, all those kind of things. And also, if they're got kids going to college and need-based financial aid is a consideration, well, that parent income, that really counts very heavily toward qualifying for federal financial aid for college. And if they're old enough and they're paying Medicare premiums and they suddenly have to show an extra 100 or 200,000 a year of income, that's going to subject them to IRMAA. So we're sort of doubling on the problem from one generation to the next. So again, stretch IRA is gone, and so we sort of have to look at, all right, what are better assets or what's a good asset to pass down to future generations other than our qualified plan money. All right, so let's talk about some alternatives. So I want to start off and talk a little bit about tax diversification. I'm sure you're all familiar with diversification from an investment standpoint, having, excuse me, stocks and bonds and cash and international and domestic and all that kind of stuff. What I'm going to suggest is we look at diversifying our tax strategy and starting to look at having different buckets of money that we can use strategically in retirement. So I'm going to start with that tax deferred bucket. 401ks, IRAs, great tools, especially when you get a match from an employer. Great way to build up assets. Again, the issue is 100% taxable as ordinary income. So what I'm suggesting is let's mix in some after-tax investing using brokerage accounts or other, type of accounts where we can take advantage of capital gains. Some of it, dividends, things like that, are ordinary income, but the great majority of this could be capital gain money, which is taxed more favorable than the tax deferred bucket. We have those lower kind of rates. And then our tax advantaged bucket, well, that's things like Roths. If someone qualifies for a Roth IRA, that's fine. Many employers now offer Roth 401ks. I take advantage of those. My wife and I both have them, and we're putting money into Roth 401ks. And then the last one, and we'll spend some time talking about this, is cash value life insurance. The cash value of life insurance does grow tax deferred. And if you take it out the right way, and there's a little footnote, very small print, if you do it the right way, you withdraw up to your cost basis first, and then you use loans, that money coming out is not taxable income. You have to be very careful with loans on life insurance policies because most people don't pay the interest. And so the interest grows and added to the loan balance. And if you let a policy lapse that has a loan, you're in for a surprise 1099 for a whole bunch of phantom income with money that you've already spent. So you just have to be careful. Most policies today have protections on them that won't allow you to take so much money out that it causes a problem. You just have to watch it. I describe it as it's when the bartender cuts you off and takes away your keys and won't let you drive home. That's the type of protection that we want to build in. And that's why we're able to help in policy reviews and making sure that clients aren't taking too much out of these policies that it's going to cause a problem.
That's why case
having those-
design, Tom, case design
Yep.
is really important for these. You get stuck in a situation where your policy can't sustain itself, then facing a lapse or a big chunk of payment's going to have to be made to keep that
Right.
in force. So yeah, what Tom's talking about is policies that actually lapse with a loan and interest and all that. So
Yep.
not a good situation.
No, not at all. But if you do, just sort of off the topic a little bit, but if you're running to clients and you're looking at their insurance and they have a policy with loans that they're concerned about, we have a very robust policy review program, and there are several carriers who act pretty favorably in what we'll call loan rescue, where we're able to take those policies and if the clients are insurable and if it's in their best interest, we can often move that to a different carrier and work on reducing the amount of the loan. So if you you run into situations like that, call Anthony and he can be a great resource.
Exactly. Thank you.
All right, so talking about these withdrawals, just some sort of simple numbers, but it's two people taking a total of 120,000 in withdrawals. The client number one, it's all qualified money. So if he loses 35% of it, he's got 78 to spend. And just again, very simply comparing taking 40,000 out of each of the three other buckets that we talked about and showing some taxation. Well, then now we've got 100,000 to spend versus 78, and I'd rather have 100 to spend than 78. So it's again, just kind of a simple example of let's have some diversification. Being able to determine, say at the beginning of the year, okay, we need X amount of dollars for spending this year. Where's the best place to get it, right? If we have some other income that's come in and we know we're going to be in a higher tax bracket, well, let's look at the other two buckets, the tax advantage, tax favored buckets. If our income is lower, maybe that's a year to do some Roth conversions and take advantage of the lower tax brackets and put some more money into the tax-free bucket. But being able to manage those tax brackets rather than waiting till April 15th and going, wow, I got killed last year. What should we start looking at? Let's do it proactively, working with your CPA. All right, let's come back to the sequence of returns risk. So we had our portfolio where the guy was taking $50,000 a year out and there was 270 odd thousand left in 2019. So the years in red are the years after market downturns. So what this is saying is if you could leave alone the other asset, I'm ignoring RMDs potentially, but if you could leave the other asset alone, you can see if you didn't have to take withdrawals from that asset, what that does to your portfolio. Now our millions turned into 1.1. So basically, and I've looked at a ton of numbers in looking at this concept. If you have between 3 and 4 years of expenses and a non-correlated asset, you can pretty much ride out almost any market condition going back a number of years. It's not 100%, but between 3 and 4 years. So it's not like we have to have $2 million sitting in non-correlated unless you're spending, $500,000 a year. But that's a way to say, let's leave those assets alone, because when you look at that chart, the market goes down, but there's a recovery. And if you have number one, the courage to stick in the market, but number two, have other assets to go to, that gives you the ability to stay in the market. And that, I think, is really critical because, again, if any of you can tell us when the market's going to go up and down and can time the market perfectly, and I don't know anyone who can, who knows exactly when to go in cash and exactly when to buy back in, it's just not a likely scenario. So having this non-correlated asset is a great way to protect against that. So what are some examples of non-correlated assets? So that could be cash, CDs, money markets. I've seen clients who say if they need $60,000 that they'll put that much in cash and use that as their withdrawals and have some protection. Not all clients can do that, and I mean, savings account rates are okay right now, but typically the return on those has been very, very low. We can look at lower risk, government bonds, other short-term bonds that have some stability. Although if interest rates react violently, that can have some risk to it. There is indexed universal life that has a floor rate. So in other words, you can't get below 0% on your indexed universal life crediting rate. That's okay. You will hear people pitch IUL saying, well, your cash value can never go down because of this 0% guarantee. That's not exactly true, because if you're not paying premiums and your account gets credited 0, well, the policy charges still come out, cost of insurance, administrative costs, all those things. So yes, your cash value could go down a little bit because of those costs. So Index Universal Life can be a great product. I own some, but like Anthony mentioned, things have to be properly designed for it to work. The product that's most associated with sequence of return, or sometimes called volatility defense, is whole life insurance. And that's simply because of the guarantees, right? No matter what the market does in 2008, 2009, whole life contracts, number one, had guaranteed cash value growth, and the companies were still paying dividends. So there was cash value growth on top of that on the non-guaranteed side. And that was probably the only asset at that point in time that had positive returns. So we know with whole life that we're going to have some positive return. And so it's often, as I said, probably the leading product for this type of concept. But you can also look at, if people aren't insurable, having some guaranteed income, meaning maybe people have enough guaranteed income when you add in Social Security to cover their fixed expenses, their basic lifestyle expenses, and then their other money goes to all the other fun spending that they want to do. But these are all ways to look about sequence of returns risk. And it's interesting. So I don't know if any of you have seen these, but I have sold a lot of life insurance where we illustrated paying a premium to age 65 and then taking income from age 66 to 80. It seemed to be just kind of a default for a lot of cases. And these were often used, and I think this is where this concept has some value, when you're talking to younger folks. Okay, as I said, I'm turning 65. There is no way I would buy a cash value life insurance policy today for cash value growth because I'm too old. There's just not enough time for it to really cook the way that it needs to. But fortunately, being in the business for 35 years, I do have an old whole life contract. And the original illustrations that I ran showed paying premiums to 65 and income from 66 to 80, and look at this great income stream in retirement. But this is a way to talk to young people who are told another bit of conventional wisdom is that you should only buy term life insurance, that all anyone ever needs is term insurance. And so what if it goes away when you're in your 60s or 70s because it's too expensive? Because you will have accumulated so much in assets, you won't need life insurance anymore. So just buy term insurance and invest. The difference, you'll do a whole lot better. We could argue about whether that's true or not. I don't think it necessarily is, but this is a concept to say to folks, look, there's a reason why people who have high net worths purchase permanent life insurance. And here's one of the reasons. But here's kind of the twist that I've discovered as I've gotten older. Fortunately, my wife and I have been able to accumulate some money for our retirement, both inside retirement plans and outside. I've actually already used some of the cash value in this whole life contract. Our oldest son started college in 2009, and so our 529 accounts had taken a bit of a hit. I was managing them, so you can imagine the wonderful conversation I had with my wife on explaining why some of these accounts had lost money in the year before he was going to school. But that was different. But I had this whole life contract that I had purchased earlier, and so we used some of the cash value to cover some of his tuition for the first year. And by then, fortunately for me, the accounts had recovered, and so we're able to go on. So how I'm looking at this now that we've accumulated some assets, I don't need to pull out the money every year out of this contract. Number one, I'm not retiring this year or next year or who knows when, but I'm not going to need the supplemental income. But it definitely is our volatility defense. If markets crash the year before I retire, that's where we're going to look for money first to use for retirement income. The other thing, because what happens when you take money out of a life insurance policy, whether it's a withdrawal or a loan? Yes, your cash value goes down, but so does your death benefit, unless you pay the loan back. You start losing death benefit. And as I get into my 60s now, and we have a grandchild coming in July, that death benefit suddenly seems a lot more important to me than the cash value from a legacy standpoint. So I guess what I'm saying is I would probably not be illustrating life insurance as showing a steady income for 15 years. I might talk about withdrawals for college. I might talk about supplemental withdrawals for this sequence of returns risk. Things that you can show clients that have, I think, a lot more meaning. And being able to tell those stories is a really important part of our work to get clients to understand the benefit of what we're talking about. But it's just kind of funny how priorities change as you get a little bit older. And then we'll talk a little bit now about legacy planning. We mentioned that IRA money, qualified money, is the worst asset to leave down to the next generation. So I'm going to talk about something that it's sometimes hard to tell clients this, but saying, look, I'm going to recommend that you pay taxes before you have to. Oh my God forbid, we pay $1 in tax before we have to. But for clients that don't need all of their IRA money, right? So if all someone has is some money in an IRA and Social Security, this is not the concept for them. This is folks that may have pensions. They may have 3 or 4 million in an IRA, other income, real estate, and they're going to say, hey, you send me these RMDs, they're just going into the bank or into another investment account. I don't need them. So let's start looking at using some of these during their lifetime, taking advantage of some of the lower tax brackets that we still have, and basically say, take an IRA withdrawal, pay your tax, and then we're going to give that money into a life insurance trust, and the life insurance trust is going to buy insurance on you. This works better with second to die coverage if you have a couple where both spouses are still alive. So we get more death benefit for the premium, but that's the money that's going to go to your beneficiaries, not your IRA money. And the reason this works so well, it's income tax free. The death benefit going to the trust and the beneficiaries, no income tax. If we have folks that have an estate tax problem, very high net worth, or they're in states that have high state estate taxes, when you show them the combined amount of income and estate taxes that are due on that IRA money, the advantage to life insurance can be pretty dramatic because it's free of both of those taxes when it's set up properly. So this can be a great way to talk to folks about how can we get more to the next generation in a much more tax efficient way. So what are the advantages of this? We talked about the legacy, enhanced asset protection. So if you have life insurance that's in a trust, the insured, the grantors can pretty much say what they want as far as how money gets distributed into that trust. So you can do things like protect against a beneficiary going bankrupt, a beneficiary having a substance abuse problem, against divorces. Right? I've been married almost 39 years. My father-in-law will still refer to me occasionally as the outlaw who took his oldest daughter. So you can be sure in the life insurance trust that he has, I am not part of that trust. Neither are any of his sons-in-law. But we can put protections in there. You can incentivize behaviors. I've seen trusts where they want to encourage children and grandchildren to go into public service type roles that may pay less in salary than private sector, and so they have some enhanced distributions for that kind of things. The grantors can do almost what they want, right? So that trust gives you a lot of protection. There's flexibility, right? Today's trusts, even though they say irrevocable, trusts can be changed now. It's depending on state laws, but you can always modify the insurance policy. They can stop taking IRA withdrawals if suddenly they need that money. So we can still make changes to things even though it's an irrevocable trust. And we haven't talked about long-term care, but the policies today can have some pretty strong long-term care rider benefits to it. And just because a policy is in a trust doesn't mean that it can't be used to pay for long-term care expenses for the insureds. It just, the trust has to be written properly and you have to have the right kind of product to do that. But you can certainly talk to Anthony or talk to me if you have clients in that kind of situation as to what the parameters have to be. But there is a way to use these assets for long-term care costs. And even folks that have high net worth, who you might say, hey, they can afford to pay for long-term care. Many of those folks, number one, don't want to use their own dollars to pay for long-term care, and especially if they have a lot of qualified money. If they need $100,000 to pay for long-term care for a year, they might need to liquidate $150,000 or more of their investments to pay that. So using other people's money and leveraging life insurance can often be pretty attractive for those folks. And finally, on the legacy planning, I'm going to talk about something that and I didn't make up the term permission slip. This is something I stole from a former manager of mine. But the permission slip. So again, bring it back to my situation. My wife and I have this old whole life contract. We bought life insurance with long-term care riders to pay for that. And then we bought a second to die indexed universal life contract. And that money, that's the permission slip. We started with a number. We have 3 sons. We started with a number that we wanted each one to get a minimum amount of money, regardless of what else we might have in our estate. So am I as concerned about a withdrawal rate to preserve a legacy? Nope. My wife and I are planning to spend on ourselves, spend on kids and grandchildren. And that first grandchild we have is going to be spoiled like you would not believe by my wife. But that's fine because we have this guaranteed legacy. For our IRAs, we have named a charity to be the contingent beneficiary. So the charity that's pretty important to us, they'll get whatever IRA money is left over. But that second to die life insurance policy, so even if I took all the cash value out of whole life because the markets did badly in the first 10 years of our retirement, and I whittled that down to almost nothing, even if we spent most of our death benefit on long-term care, both of us, which is possible, we have some longevity and unfortunately some Alzheimer's on both sides of the family, so that could be. But even if we do all that, we still have the life insurance. So that gives us the comfort to say 4%, 5%, 10% withdrawal rate. I'm not going to say I don't care, but I don't really care that much because we've got something else taken care of. And the whole thing about this, if I was starting this planning today, I couldn't do it. And most clients, if you start when they're in their 60s, it's really hard to do all of this. Maybe you can do the legacy part, but you can't do all of it. So this is kind of a long way of answering the question, I guess sometimes, is how do we get someone who's in their 30s who's trying to raise a family and save for college and retirement, and their parents, how do we get them to look at permanent life insurance? Talk about some of these things and then help them find the dollars to do it. That's kind of one of the points of all this is we need to get folks starting when they're younger. All right, so summary. If we have properly structured permanent life insurance, right, we have tax diversification, we can protect against sequence of return risk and provide additional tax-free legacy. And as I said, Ernst & Young has twice confirmed that. If anyone wants to see the reports, they're pretty long, a lot of detail, but I'd be happy to send those along if people want to take a look at them, just to kind of give you some backup on, hey, this isn't just, Tom from an insurance distribution company saying you ought to do this. This is Ernst & Young who have confirmed this twice. So I will stop and see if we have any questions or if there are any other topics you want me to talk about.
Tom, I would love to get that information because, like I said, we are, what makes our group so special is the Perennial Legacy is bringing the insurance solutions to our advisors so they can focus on what they're good at and grow their business. And we are here to bring the solutions, insurance, the risk management solutions to our group. So this is amazing. I took a lot of notes. Do we have any questions? Okay. I know that what we did, we recorded this and we are going to send it to our internal group, and we'll have more questions probably coming. Anthony DeMeo, thank you so much for always being there for our group and your partnership. He's available, his information. If you go to Crump website, you can get, he has a whole team, advanced team that can help us with the case design. I'm here for additional or the source for insurance solutions. We definitely we'll have more questions coming unless if somebody else said, Anthony, you want to add anything?
No, that was it. Thank you very much. And yeah, it's just we're just trying to bring timely ideas that resonate with you. Like I said, that we're using across the country with advisors like yourselves, and taxes are always a hot topic, and mitigating those and figuring out how to pay for long-term care. And nobody, like I said, nobody wants to use their own money. So there's great ways to leverage it, very tax efficiently as well. So anything comes up, I'm a phone call away, and so is Tom. So thank you.
Awesome. Thank you so much. Thank you, Tom. Thank you, Anthony. Thank you, everybody, for being on the call. And we will see you next again. Last Thursday of each month at 10 a.m. is our coffee talk. So we will send out the reminders and also the next topic. Thank you. Have a great day.
Thank you. Bye-bye.
Bye, guys.